Hey dividend investors, today I'm going to be breaking down a couple of different dividend ETFs that you might like to invest in February of this year. And maybe into the future as well if you're watching this in the future. But all of these ETFs are going to be really dedicated towards dividends. Some I've already talked about, while others I have not. Let's get down, let's check these out. So the iShares Select Dividend ETF, it goes by DVY, is a very good dividend. It's currently sitting on the NASDAQ, so it is an American ETF for all of those Canadians like myself. You would probably want to invest in this on your American portion of your trading account. But let's check this out. Let's see how it really does work. And of course, number one thing I want to look at for dividend ETFs is the yield, and currently sitting at 3.66%. Now, if you're confused about that 4.28, that's, of course, over the past year. Of course, there was a little bit of a pullback, and that's why that's a bit higher, but that's totally okay. From there, the next thing I want to look at when it comes to ETFs is their MER. How much does it cost for me to have their ETF, and then at the same time, how much are they going to be charging me for them to invest for me? And of course, 0.39 is not terrible. It's a heck of a lot better than most mutual funds, and at the same time, it's not horrible. You're only looking at 39 cents really for every $100 that you're putting in, and that's every single year. So that roughly comes out to be, in my mind, around 3 cents a month for every $100 that you have in there. So keep that in mind. It does cost money to invest in ETFs if you don't already know that. From there, the 52-week high and low is another thing that I want to look at, and also the volume. First off, 52-week high, it's getting close to back where its high was. 107 is its high, it's currently sitting at 100. And $61 was the low point, and that was way back. We'll be looking at the chart anyways, but that was back when the market was taking a market-wide hit. From there, the volume is pretty good. Now, today's volume, this was taken earlier on in the morning. 69,000 shares crossed the table. Its average volume is 791,000. That's a liquid enough ETF that if you wanted to get out of it fast, you can. So this is the chart. And of course, the chart on this one looks pretty interesting. So we had that long-term rise on this side. And then when it did pop off of its low, we could actually see way back, interestingly enough, that when you start looking at charts like this and it doesn't hit back to its average high, I'm going to call it. There's other words for it. I'm just giving you basics anyways. So here back in 2018, we can see that there was a little bit of a shakeup, and then it did drop quite substantially. But it did recover, and it did come down to a point once again. See how you can look at the charts and say, well, that's going to be the average here. That's going to be the average here. Well, once a market starts going in the middle of where it's been trading in the past, it's about to collapse, or at least go down slightly. And usually that's what happens. And from there, we could see back in roughly July that there's going to be something happening into the future. Now, this is when across the whole market you were seeing this, and I was actually just collecting cash at that point. I was not investing. And then the coronavirus hit, and of course it has recovered slightly since then, but that's just something interesting. I always like to really show people who may not really follow the market all that much. Some of my friends, people like that. Anyways. Now, when it comes to the holdings, that's another thing that I look at when it comes to ETFs, and the holdings are pretty solid. Wells Fargo, there's a lot of people who hate it. I don't mind it. Banks, I am a huge fan of banks. There's a lot of oil companies and energy companies on here as well. When we scroll back up, and we can see the actual sector weighting, it's mostly going to be in utilities, consumer defensive, financials, cyclicals, as well as energy, oil, that kind of thing, and a little bit of into technology. The biggest major things, though, is financials, which I personally really like. There's a reason why they're called financials. It's because they print money, in my opinion. And from there, communication is going to be disrupted someday, but not right now, by SpaceX. Now, this is one I've talked about before on this channel, the BMO Canadian High Dividend Covered Call ETF, ZWC. And from there, what we really want to look at and really see is the expense ratio is quite high. It's 0.65. From there, the yield is also massively high. It's 8.15. Now, something that you need to know about this one. The average volume is not massive, but it is a good amount. It's 134,000 average shares per day. Now, something that you really do need to keep a thought on is the fact that this has been declining in the past before coronavirus. However, so was the whole entire Canadian market. It was kind of shaky leading up to the coronavirus. That's why I thought the coronavirus was actually going to totally wipe out the Canadian market, for even worse than it really did, because we were having oil issues back here, and then from here to here we were having house income issues, credit issues with people, where there was just such high debt in Canada, and that's why everything was trading pretty well level. Something was going to happen, we didn't know what. And again, like I was mentioning, from here-ish to about here, I was selling things, I was getting out of the market, I wanted to be in cash, and I was 80% cash when this happened, and I was buying all the way down. But not just on this ETF, many other stocks and ETFs. But from there, that is why this has not been performing very well. Once our Canadian market and our Canadian economy recovers from what was happening from here to here, and then recovers from here to here, we've got some lengthy recovery ahead of us in Canada. What's going to be nice about this one is you don't have to worry about currency fluctuations when you're investing in American stocks and things like that, because this is not investing in any American stocks, but you are getting a high dividend to get you through this time. And this is what I mean by solid investments. So Enbridge, Oil, CIBC, Bank of Nova Scotia, all financials. Rail is, of course, not energy, but that is an energy play in Canada because they just have no way of getting oil out of the oil sands. The Americans, Biden has canceled the pipeline. We can't get pipelines through the native land. It's just a massive hassle trying to get oil through to anywhere outside of the oil sands. So Canadian National Railway seems to be the only way to get it out. BCE and Shaw are both going to be massively disrupted by SpaceX, in my opinion. There's another pipeline. We need pipelines, and they are just not getting made. Same as TransCanada, but I really like TransCanada after that big pipeline down in the States got canceled. I think that was just going to be a massive money hog, and I don't think that the investment was going to be worth it after so many different presidents saying yes, and then another one saying no, and another one saying yes, and now another one saying no. It just seems a big, massive headache. And, of course, Bank of Montreal. And, of course, another covered call, which is another one that I do own myself and I've talked about constantly on this channel, is ZWK. Again, higher expense ratio, 0.65%, but it does have an 8.44% yield. Of course, on this ETF, as well as the last one, they are covered call ETFs, which means that they are using an option strategy to get you yield while still owning stocks to be able to increase in value and actually run the covered calls, because you're essentially running or selling a call against 100 of the shares that they have, which they do that apparently with roughly 50% of what they own, which is why they can have such high yield. Again, lower volume. I really think that this will change once more and more people start knowing about this ETF. We have to remember that the American banks and the American financial system is still strong. Goldman Sachs had a fantastic quarter, and a lot of other banks did as well. Now, this is the chart. Of course, this is only a little over a year of a chart, even though I have it set for 5 years, mainly because this has not been around for very, very long at all. But as we can see, it did drop out of the gate, but so did any of the financials did at that point. And then we were starting to have a very good time coming into towards 2020. The American banks were starting to do really well. Financial system was strong, and then roughly around here we started getting news from overseas. Now, I know a lot of people didn't start noticing it until about January, but yeah, there was a lot of issues. Some of those crazy right-wing conspiracy groups were starting to say back in December that there was some crazy stuff happening over in China. Nobody was listening to Taiwan or the crazy conspiracy people. And of course, what they were saying was right, and the market plummeted. If you got it around here, I know you were getting well over a 10% dividend yield on this investment, which I purchased right about there. And from there, it has grown nicely, and I think with this recent pullback that we have right here over the last couple of weeks is a fantastic time to get back in if you were sold, or to get in if you are a new investor into this ETF. I hope that this video has helped you with some ideas for this month. If it has, hit that like button and subscribe, and I'll see you guys again next time.